Welcome back to week 4. In the first part of this week's lecture, you saw how banks guard their capital, protect liquidity, and manage the ups and downs of interest rates. That was the foundation. Now we step into the real world of lending, where risks don't stop once the ink is dry on the loan documents. Every loan is a story, and not all stories end well. Some borrowers run out of cash. Others hit hard times or make choices that break agreements. That's where tools like collateral, covenants, and guarantees come in. The safety ropes that banks rely on when borrowers slip up. But the plot thickens. Beyond credit risk, banks face a whole cast of other risks. Hackers trying to breach their systems, regulators demanding compliance, and the ever-present danger of bad publicity and lawsuits. These risks may not grab the headlines the way loan losses do, but ignore them and a bank collapses just as quickly. So in this session, we're going to dig into how banks manage credit risk at the ground level and then widen the lens to see the operational, reputational, and strategic risks that round out the picture. Because understanding these risks isn't just academic. It's what separates a stable institution from one that ends up scrambling for survival. Loans are always risky, and no bank can eliminate the risk completely. What can be done, however, is to reduce exposure. The 3 primary tools for this are collateral, covenants, and guarantees. Think of them as safety nets that catch the bank when borrowers stumble. Collateral is the bank's backup plan. These are assets, cars, equipment, real estate, receivables, things that can be seized and sold if a borrower fails to make the loan payments. Collateral has to be perfected, meaning the bank holds clear legal rights to claim it. Without that, it's nothing more than a promise. Loan covenants are conditions built into the loan agreement. Positive covenants require the borrower to maintain certain standards, like providing regular financials or keeping minimum cash reserves. Negative covenants restrict actions, such as taking on more debt without permission. To borrowers, covenants can feel like chains. To banks, these are the guardrails that prevent reckless borrower behavior. A guarantee extends repayment responsibility beyond the borrower. A parent company might guarantee repayment on behalf of a subsidiary, or an owner might pledge personal wealth. These guarantees widen the net of accountability and give the bank additional assurance that repayment will be made, even if the borrower defaults. The loan agreement ties everything together. It documents the promissory note, the collateral, the covenants, and the events that might trigger default. This is the rule book that governs the loan from start to finish. When disputes arise, everyone returns to this document to settle what was promised and what must be done. Monitoring and disposition. Healthy loans require ongoing monitoring. Reviews of large or risky loans are done more frequently, checking collateral values, payment performance, and compliance with covenants. But when loans deteriorate, they move into workout. This is the last resort where the bank restructures terms or negotiates with the borrower to recover as much as possible. Evaluating a consumer loan application. Consumer loans are evaluated differently than business loans. A bank will look at employment stability, income levels, savings, housing situation, and of course credit history. Each factor tells a story about the borrower's ability to repay. Sometimes a cosigner provides the extra assurance needed for approval. Credit scoring. Scoring systems take those attributes and assign points. High scores earn automatic approval, low scores lead to rejection, and mid-range scores trigger further review. These systems make decisions faster and more predictable, helping banks process large volumes of consumer loans efficiently. Operational and technology risk, Chapter 14. This risk arises from failures in systems, people, or processes. Cyber attacks, fraud, and even natural disasters can cripple a bank. These are not theoretical threats. They are operational disruptions that can drain resources and erode customer confidence overnight. Compliance risk. Banks operate in a heavily regulated environment. Compliance risk is the danger of fines, sanctions, or restrictions when rules get broken. This could come from ignoring formal regulations, overlooking examiner guidance, or simply failing to keep up with new laws. Reputation is the bank's most valuable asset, yet also its most fragile. A single ethical lapse, a social media firestorm, or a leaked story can drive away customers and investors. Rebuilding lost trust can take decades, if it can be rebuilt at all. Strategic risk comes from poor decisions or failed plans. Expanding into the wrong market, missing changes in customer behavior, or investing in outdated technology can undermine performance. A sound strategy, backed by good execution, is just as critical as financial strength. Legal risk arises from unenforceable contracts, lawsuits, or adverse judgments. Poorly drafted agreements or disputes with vendors can drain capital and distract management. Clear contracts and proactive legal oversight are essential to keeping this risk in check. So that brings us full circle. Credit risk doesn't disappear when the loan is approved. It has to be monitored, managed, and sometimes worked out when things go south. That's why banks rely on tools like collateral, covenants, guarantees, and detailed agreements. They give structure to uncertainty. As you've seen, the job doesn't end there. Banks live with a wider set of risks. Systems that can fail, regulators that have to be satisfied, reputations that can shatter overnight, and legal challenges that can tie up resources for years. Each of these risks may seem separate, but together they shape the strength or the fragility of a financial institution. The lesson is simple. Banking is not just about making loans or holding deposits. It's about anticipating problems before they happen and putting guardrails in place to keep the financial ship upright. Banks that respect these risks stay in business. Banks that don't end up as case studies in college textbooks. As you prepare to complete this course, and more importantly, preparing for the next stage of your career, keep that perspective in mind. Risk is everywhere in banking. The real measure of a good banker isn't simply avoiding risk, it's managing it well.